All right, a blessed day and welcome to B2C Tutorials. My name is Bernard and welcome. Today we want to discuss financial statement analysis and its interpretation. Okay, so when we say financial statement analysis and interpretation, it refers to the systematic process of reviewing and evaluating an organization's financial statement in order to understand its financial performance, position, and cash flows, and to support informed economic managerial decisions. Basically, the analysis is to do some calculations on the financial statements of a firm, and the interpretation is to actually read some meaning into the analysis that has actually been done, which would help management take an informed decision. Now, the question that you want to ask yourself is that what are these financial statements? What are these financial statements? So these financial statements are one, we have the statement of profit and loss. We have the statement of financial position, also known as the balance sheet. Then we also have what we call the cash flow statement. These are the major financial statements of every firm. So you see your accountant busily preparing these financial statements, and they would have to then analyze them and interpret them to management for them to use them to take a decision. Whether you are an accountant or not, from your letter canal, you should also be able to understand whatever the accountant has presented to you for an informed decision. Having said that, the statement of profit or loss, also known as the statement of financial performance or income statement of a business over a specific period, it shows how the firm is performing. The statement of financial performance or the profit or loss account tells you how the firm has performed within a period of time. Okay, so over the specific period can be 1 year, can be 2 months, can be 3 months. So what is it supposed to do? The statement of profit or loss account is supposed to report the revenues that the firm has earned and the expenses that the firm has incurred. So to a layman's understanding, when you receive your salary and then you spend from your salary, it tells you how you are performing within a period, that is 1 month. So when you're done, you can actually analyze whether you have some money left on you or you don't have any money left on you. Now, how about statement of financial position? That is the balance sheet. This statement shows the financial position of a business at a particular point in time. So this statement will tell us that this is what the firm has. This is what the firm is owing at a particular time. So the performance is telling us how well we are doing. The position is telling us what we particularly have and what we owe. Okay, so that is what a financial position is expected to do, to tell you what you owe and what you own. Okay, so this financial statement presents what the business owns. So whatever belongs to the firm is the own, OWNS. We call it the assets of the firm. Then we have what they also owe, which is called the liabilities, your debt, your what you are obligated to go and pay. The own is what you're entitled to receive. And owner's interest. So what's the owners contributed, their interest is called equity. So there are three major headings in the financial position known as the assets, liabilities, and equity. Then also with the statement of profit or loss account, there are two broad items that we'll find there. That is your revenues and then your expenditures. Having said that, the next one is your cash flow statement. This statement shows how cash is generated and used during a period. It is divided into the operating, investing, and financing activity. Now, the cash flow statement basically deals with cash that has been received and cash that have been spent within a period. So if it is 1 year, the cash that have actually been spent, sometimes you can buy items from people on a credit basis. Okay, so if you buy item on a credit basis, it is not supposed to be shown in your cash flow statement. But then if you buy an item and pay cash for it, comes to your cash flow. Now, the cash flow can be broadly divided into operating, investing, and financing. When we talk about operating, your day-to-day activity as a firm. So the monies you paid and the monies you received as a result of your day-to-day activity as a firm. That is what we call operating. Now, investing. The firm can actually buy shares and they'll be receiving some interest, or the firm can actually be involved in any investment in another item. Now, once you receive a return on your investment and then you also pay money to invest, these would form part of your investing activities. Then we have financing activities. That is, you are buying maybe you are buying heavy equipment for your firm, like the plant and machinery. You buy a computer for the firm and you pay cash, or you realize that the computer for the firm is in a deplorable state, so you decide to sell it off. Once you sell it off, you receive money. So money will come in. And then once you also go and spend and buy it, you pay money. So money goes out. So in the cash flow statement, you'll be doing what we call cash inflow and outflow, but under these three broad topics. Our interest will be on the statement of profit and loss account, and then the financial position, that is the balance sheet. Now, just like I said, the other names for the statement of profit or loss, that is the income statement, can be called statement of financial performance, profit or loss account, or income statement. Now, this is the format. This is the format. When you pick your profit or loss account, we need to see net sales. Another name for net sales is called net revenue. I would explain what net sales or net revenue really means. Okay. And then let's look at the next item. It says that you need to deduct cost of sales, or another name is called cost of goods sold, from your net sales to arrive at what we call the gross profit. So this gross profit is a mathematical equation after you have deducted your cost of sales from your net sales. Now, when we say gross profit, always have it in mind that it is your net sales minus your cost of sales or cost of goods sold. Then the next we have to do is to less operating expenses. That is the expenses that you normally incur. Once you less these operating expenses from the gross profit, you get what we call net profit before interest and tax. Then you would also deduct what we call the interest. This interest is what you pay on the bank loans that you are taking, or the debentures. You know, debenture is a form of loan. Now, all these type of loans that you take and you are paying interest is what we treat here. Initially, we used to treat it under operating expenses. But then with the recent changes in the IAS, the International Accounting Standards, we don't treat it in operating expenses again. But now it is being treated after you have arrived at your net profit before interest and tax. Then, after deducting the interest from tax from your net profit before interest and tax, you now get what we call net profit before tax. Now, in this net profit before tax, you now come and charge your tax. After you charge your tax and deduct it from the net profit before tax, you get what we call the net profit after tax. Now, when you get net profit after tax, you are not done. There are instances where you have to pay preference dividend shareholders their money. So once you pay these people their money, you get what we call net profit available to ordinary shareholders. Now, who are preference dividend? They are people that have also given you their money to do business with. But then, as a result of doing business with those monies, you have to pay them some dividend. And they are the first point of call when you are paying dividend. Okay. So whenever you pay, you want to know what is for the owners of the firm. Ordinary shareholders are owners of a firm. If you want to know the profit that you are going to share for those people that are actually owners, you might have first paid the preference shareholders their dividend before you can go ahead and pay the profit, or to know the profits that is going to be given to the actual owners of a firm. So ordinary shareholders are owners of the firm, whereas preference shareholders are not owners of the firm. Okay. Now, this is the format. We want to pick the items by items and explain them. When I say item by item and explain them, I mean, when we say net sales, is it just net sales? What goes into net sales? You see, when you sell to someone, you sell to a customer, and then you receive the money, and the customer brings back some of the items that they don't like. We call it sales returns. He has returned the sales, or we call it return inwards. Once there is something like return inwards or sales return, then you get what we call the net sales. The question I have for you is that it is not all questions that you see return inwards or sales return in the question. Why? Because net sales or net revenue it represents the actual revenue that you have earned from selling or sales after deducting your sales returns or return inwards, another name, return inwards or sales return. If I sell goods to a customer and then I collect the money and the customer does not return anything, then it means that whatever that I earn becomes my net sales. However, if I sell and the customer returns it, I have to deduct it from the money. So if I have 10 CDs, if I sell 5 t-shirts and I received 200 CDs as my sales, and then the customer does not return it for me to refund the money, the entire 200 becomes my net sales. So it will mean that minus zero, there was no return. But assuming, which will be the same as 200, so that becomes my net sales. But then assuming that you sell, and when you sold the goods, you sold them for 200 CDs. A customer was dissatisfied, so the customer returned 50. You have to definitely pay the customer the 50. So what will be left with you is 150. That is what we call net sales. If you don't see it, if you don't see sales return or return inwards in your questions, then it means that whatever you sold and collected becomes the net sales. That is fine. That explains the first part of the format called net sales. Now, how about cost of sales or cost of goods sold? What goes into cost of sales or cost of goods sold? Now, it says that cost of sales represents the direct cost of producing or purchasing goods sold during the period. So the cost that you incurred to buy the goods that you are producing as a firm. Okay, now this is the format for cost of goods sold. Let me tell you, it is your opening stock, or another word is opening inventory. Opening stock or opening inventory plus your net purchases minus your closing stock or closing inventory. Now, these words might look broad to you. Assuming I am into the sale and purchase of eggs. Sale and purchase of eggs. So, as at yesterday, or when I began today, I began with some, one crate of egg has about 30 pieces. One crate has about 30 pieces. Okay. So assuming every day I want to sell one crate of egg. So one crate of egg, which has about 30 pieces. Today, when I was beginning, I was unable to sell the whole eggs yesterday. So assuming I begin today with 10 pieces, it becomes the opening. I begin today with 10 pieces, so it becomes the opening. Then, during the course of the business, I bought, let's say, one crate again, which is 30 pieces. That is purchases. I bought 30 pieces, which is equivalent to one crate. And then when I was closing today in the evening, I can count like 5 pieces of egg. So I want to find out the direct cost or the direct number of eggs that I sold during the period. So closing. closing. The direct cost that I sold during the period. Okay, then it means that they are telling us cost of sales is basically the number of eggs I began with today, which is 10 pieces, plus my purchases, which is 30 pieces. I would explain net purchases to you, minus our closing inventory, which is 5. It means that I was able to sell 35 pieces within the day. That is the meaning of cost of sales. So always, if you are not given cost of sales, and then the question reads out, and then you are supposed to find out what cost of sales is. Cost of sales is basically the opening inventory plus your net purchases minus your closing inventory. Now, the question is, what is net purchases? I've explained opening inventory and closing inventory. That is the goods you have begun with today or the goods you have left at the end of the day. What you begin with today is what we call opening, and what you left for today is called closing. Now, if I leave 5 pieces for today, when I am starting tomorrow, I'll start with the 5 pieces again. So tomorrow I'll start with the 5 pieces. So the same 5 pieces that I left today will become the opening for tomorrow. That is about closing and opening inventory. Having explained that, or having said that, the next line of question is that what is net purchases? What is net purchases? Just like you have net sales, where you sold goods and some people were dissatisfied and they had to return it. The same way when you buy goods, you would also be dissatisfied and return it. If you are not dissatisfied and you don't return it, it becomes zero. Okay. So I bought goods worth 200 cedis. I was not I was satisfied, so I didn't return any goods. But then when I bought the goods, I didn't get help from anybody. When I say carriage in what, it can be the boat fee you paid for, it can be the transportation you actually paid for conveying the goods to your firm. It could be let's say the kaya you that you paid for to bring the item, the carriers or those with the little wheelbarrows that they would help you to bring that thing to the business. Okay, that is it for um the net purchases. But then yes, there can be a question whereby when you bought the 200 set of items, so that's that I was saying, you bought the 200 items, you came to look through the things, you were not happy, you have to return 70 cedis of the item or 70 pieces, and then the person that helped you bring the items, the taxi, the transport, the means that you brought the thing in, you also paid, let's say, 20 for it. Now, you know that 20 minus 200 minus 70 is 130 plus another 20, which means that 150. So your net purchases is 150. However, if you don't incur any cost or you don't return any item, then the 200 still remains as your net purchases. The 200 cedis still remain as your net purchases. All right. Having said that, you can now understand fully what goes into net sales and what goes into cost of sales. So cost of sales, we've established it is opening inventory plus net purchases minus closing inventory. Then the question is that what is net purchases? Then you now come and then look at it. But it depends on the question that has been given you. I am explaining this in the concept that you don't know the question that will be before you, or you don't know what you are going to face in your own business, or you don't know what you are facing in reality. Okay, so you see, what I explained with net purchases is in reality what is happening. But then in reality, you can also have it in the case whereby you bought the goods, you carried them on your own, you didn't incur any extra cost, you just walked to your workplace, you didn't buy any yogurt or anything. So that becomes what we call the net purchases. So the cost of the items becomes the net purchases. Now, what is gross profit? It says that when you deduct that cost of sales from your net sales, you should get what we call the gross profit. So gross profit shows the profit made from your core trading activities. So like your gross salary. So the gross profit is from your core trading, what you do. After you've not considered anything like your expenses, that is what will lead to gross profit. So it is net sales minus cost of goods sold or cost of sales. Having said that, what are some of the operating expenses? These are indirect costs that you incur to run the business. They are not the cost for the eggs, but then these are the salaries you pay to the person selling your egg for you. Maybe you are keeping the egg in a shop, the rent you pay for the shop, and also you have what we call maybe you have electricity in the shop, you'll be paying for electricity, you'll be paying for airtime where the person has to call a customer to follow up, and then maybe you keep a waste disposal where after you eat, drink, you had to discard them to the waste bins and all of that. All these things are the indirect costs. They do not relate to what you are doing as a firm. The firm is dealing in eggs. So whatever cost we incur with relation to the egg is what we call the direct. But any cost that we incur that will help us run the firm is what we call the operating expenses, and they are indirect to the egg. You cannot see the cost with the egg. So example, water, electricity, fuel, telephone, airtime, waste disposal, transportation, depreciation, stationery, salaries, wages, rent, maintenance, and repairs. All this would constitute your profit or loss or otherwise income statement or statement of financial performance. Having discussed this, we want to discuss the next statement, which is the balance sheet. The balance sheet. The balance sheet. Now, if you have any question, you can try to contact any of the numbers above via WhatsApp. And then we would sort you out. Or if you have any further question, you can drop it in the comment section where we would address your question for you. All right. Having said that, it says that the statement of financial position, also known as the balance sheet, this statement is used to determine the position and the stability of a firm at a given date. We want to know how stable the firm is. Will the firm continue to do business, or will the firm have to stop doing business? That is what we find in the statement of financial position. Now, I told you that there are three major headings that are there. That is the asset, the liabilities, and the equity. That is the owner's interest. Now, under asset, that is what a business owns. We can have two items. One is called non-current or fixed asset, and the second one is called current asset. When we say non-current or fixed, we mean that these are items that belongs to the firm and can be used for more than 1 year. An example, the motor vehicles in the firm, the computers and laptops in the firm, the furniture and fittings, the cupboard and all those things in the firm, the plant and machinery. So if you come to the egg business, I'm not sure you can have a car, but if you have a motor vehicle for your delivery, then that becomes a fixed asset or a non-current asset. Then you can sometimes also have what we call computer. Maybe you use it to keep records of customers. Then you can have a chair table, a cupboard, and whatsoever that have you. Then you can also have heavy machineries to produce light or to be used in production. That is what we call the plant and machinery. These items can be used more than 1 year. And that is why we call them non-current asset or fixed asset. Now, when we say current assets, we are looking at the assets, the things that belongs to you that can be converted to cash within 1 year. Things that can be converted to cash within 1 year. The very first one is called the closing inventory. You see, that closing stock or the closing inventory you left in yesterday, that you were the closing inventory you are leaving today, that you were unable to sell. It is an asset. It belongs to you, so it is called an asset. Okay. Then we have what we call trade debtors or trade receivables. Who are these people? These are people that bought goods from you on a credit basis. These are customers that bought goods from you on a credit basis and decide to pay you within 1 year. So they are called trade debtors or receivables. So you sold goods to them on a credit basis without taking money. So that those people, they are treated as your asset because they will pay you, so it belongs to you. Then we come down to what we call cash or bank balance. Your cash you have today or the money you have in your account is also yours. So it becomes what we call uh, an asset, current asset. You can actually assess them within a period of 1 year. We have what we call prepaid expenses. That is monies that you have uh, paid in advance to people for 1 year. It is your money, so you've paid it to people. Okay. Then let's go down to liabilities. Liabilities. That is the debt you owe or what the business owes. That one can also be grouped into current and non-current. The non-current, just like we said, it is more than 1 year. So the obligations you have to pay beyond 1 year. An example is bank loan. When you go for bank loans, sometimes you're expected to pay over a year. Then we have debentures. They are also form of loans or debts that you have to pay over a year. We have long-term debts that goes beyond 1 year, and we have bonds. Bonds. Recently, a nation went for 100-year bond, which is expected to pay within a period of 100 years. So it goes beyond just a year. Okay, then we come down to what we call current liabilities. That is obligations within 1 year. You're expected to pay or make commitment within a year. We have trade creditors and payables. Just like people buy from you on a credit basis, you can also buy from people on a credit basis. So when I buy item from someone on a credit basis, I am expected to make payment within a period of a year. Once I am going to do that payment within a period of 1 year, that person will be called a trade creditor or payables in my book. All right. Then we have bank overdraft. Usually, when you save with a bank and you want to draw more than what you have in the account, that's what we call. So you have like 5,000 in your account. You plead with the bank and you have overdrawn the amount of money you have in your account. You have a bank overdraft. It's a form of loan that the bank is giving you. But then you must have an account or something with the bank so that they can actually overdraw what you have in your bank. That form of debt is paid within 1 year. Then we have what we call the owner's equity. That is the equity. It consists of stated capital. It is what the firm owns. What belongs to the owners? And I've told you the owners of the firm are the ordinary shareholders. They are the ordinary shareholders. So we have stated capital. That is the amount of money they contributed, the capitals they contributed. We have net profit for the year. This net profit for the year is actually coming from the statement of profit or loss account. The profit that you make, you have to add it to the capital that people have contributed. Then we have what we call the retained earnings. Anytime you make profit as a firm, you can decide to spend everything or you can decide to set some of the monies aside. So the monies that you set aside can either be called retained earnings. Now, in the following year, we have reserved some of the money, and that can be called reserves. In the course of the business, if one of the owners decide to withdraw some of the money that he has contributed as a stated capital, you need to deduct it. Okay, so this constitutes what we call the equity or the owner's interest, and these are the components. There are more, but this is what you need to know frequently at your level. All right, so that will end the discussion. I don't want to discuss statement of I don't want to discuss the cash flow statement. So let us discuss this too at the interim, and we'll discuss the others in our subsequent videos. Okay, having said that, this is more about the financial statement. How do you then analyze this financial statement? Having understood the financial statement and how it is prepared, how then do you analyze them? Okay, so you can have a question where they would give you the financial statement that has already been prepared and you are supposed to analyze them. Other times, the question will not be given, the financial statement will not be given you, but then a bulleted point will be given you like what you have here. Some bulleted points will be giving you like what you have here in the question that you're saying. So it says that illustration, sales, opening stock, purchases, operating expenses, stated capital, surplus, and what have you. And once it is giving you like this, they have not prepared the financial statement for you. So you are expected to use the given information to solve the analysis. So to be able to do the analysis, you need to understand that there are 5 basic analysis that we need to do. And these analyses are the profitability, efficiency. So we have the profitability, we have the efficiency ratio. We use ratios for our analysis. And then you do what we call the liquidity ratio. We have the gearing ratio. Then we have the gearing. We have the investment. These are the 5 basic that I want to walk you through. But then before I walk you through these basics, I normally like to start from the liquidity because it has just 2 computations you need to do. We have 2 computations under the liquidity that we have to do. So when you pick the liquidity, it says that it tells how quick the firm can pay its debt when the firm is when the firm is collapsing. So liquidity basically means that when the firm is becoming illiquid, when they don't have cash, can they pay the debt they owe? That is the meaning of liquidity. Can you pay the debt that you owe? If yes, then let us look at it from current ratios perspective. It says that your current assets over your current liabilities. And we've looked at what current asset is, and then we've looked at what current liabilities are. So you just sum the current assets up, you divide it by your current liabilities. That will give you current ratio. Okay, so that will give you your current ratio. Current assets divided by current liabilities. So if I have current assets, like we said, your bank, your closing stock, so if I've, assuming you have been given a financial statement like this question. Now, current assets, current liabilities, they are balance sheet item just like we discussed. So assuming this is our financial statement, this is our balance sheet that has been given to us for the year 2020, 2008, and we are supposed to analyze it. You realize that we have fixed assets and quite a number of items are listed beneath it. We have current assets such as stock at cost, that is the closing stock, trade debtors, and bank. These are all current assets. So the total from 300 to 3.4, when they sum them up, they had 544.2. That is your current assets that you use. Then your current liabilities are the creditors that are due within 1 year. So those that you are expected to pay within 1 year, they are your trade creditors. You have dividend proposed and then corporation tax. Now this question has given them to you. So they've already summed them up, which is 291.7. Now, when you divide the 544.2 by the 291.7, that we say you have determined what we call the current ratio under liquidity. 544.2 divided by 291.7. So you have 1.86 times. So it is number of times your assets can pay your liabilities. The number of times your assets can be used to pay your liabilities. And so from that same question, we saw that we have 544.2 divided by 291.7. Then it means that your assets can be used to pay your liabilities 1.87 times. Okay, 1.87 times. So this is measured in times, looking at the number of times what belongs to you within 1 year can be used to pay the debt you owe within 1 year. Then we go to the next type of liquidity ratio, which is called the asset test ratio. Now, that asset test ratio is looking at what you have minus the stock. You see, it is believed that if we don't have stock and people are not buying them, or if we have stock and people are not buying them, we cannot perform the asset test ratio. So here, the concept is that if you have a total asset or total current asset of 544.2, look through the asset. Is there anything like inventory or stock
Yes, we have stock at cost at the closing 300. Deduct it. So the concept is the same as the assets of the 544, total current asset of the 544.2, minus any closing stock or closing inventory, that is the 300, according to the question that was displayed, all divided by the current liabilities of the 291.7. Now, when I do this, I would receive what we call a solution of 544.2 less 300 divided by 291.1.7. So 0.84. It means that my asset can be used to pay my current assets less my stock can be used to pay my liabilities 0.84 times. 0.84 times. Now, that is the interpretation. After getting the answer, what you have done is just the analysis. Then I used to explain that, okay, in current ratio, my asset can actually be used to pay my liabilities in 1.87 times. That is the analysis or the interpretation. Then the interpretation for the acid test ratio states that my asset can be used to offset my liabilities 0.84 times. Now, that is all about liquidity ratio. There are just two things here, the current ratio and the acid test ratio. So if you really understand this, you can be able to do it. So anytime you are given a question and then the financial statement is provided, this is how you pick them and then solve them. That explains the liquidity. Now, what next would I like to discuss when it comes to this? I would like to discuss what we call gearing ratio. When we say gearing ratio, we are looking at how risky the firm is, looking at the debt that we have taken. You know, you cannot start a firm without going for debt, or you can't start a firm and then assume to do everything without any loan. So the gearing ratio is telling us how risky the firm is with respect to the amount of money we are owing in terms of debt. So when you go to gearing ratio, it says that the long-term debt that we have divided by what belongs to the firm, the owners, plus the debt. So here, the denominator, when we say denominator, the one on top is called numerator, and the one beneath it is called denominator. When we say denominator, and then we are looking at gearing, they say go to your balance sheet, pick what you are owing that goes beyond 1 year, all right? Then two, divide it by what belongs to the owners under the equity plus any long-term debt again. So quickly, when you go to the financial statement, from capital downwards, from this part downwards, it's what belongs to the owners. What belongs to the owners is their shares that they have contributed, the reserve that they have contributed, and then anything like retained earnings. So retained earning, I told you another name could have been reserves, because it is money that you are setting aside. Now, if I add this, I add this, I add this, it is the monies that belong to the ordinary shareholders. That is the shareholders of the firm. So this 498.3, these are monies for the ordinary shareholder. And they are saying that, okay, to know how risky the firm is, we just need to divide what we have gone to borrow, that goes beyond 1 year, divided by what belongs to the owners plus what we have borrowed. Okay, so when you look at the financial statements that we have, creditors due beyond 1 year, these are the debts that we have borrowed that goes beyond 1 year, and it is just 200. Hence, the 200 divided by what belongs to the owners plus that same 200 that we went to borrow. And so you see here as the 200 they've borrowed divided by what belongs to the ordinary shareholders, 498.3. What belongs to the ordinary shareholders, 498.3, plus the monies that we went to borrow that goes beyond 1 year. And that will give you the gearing ratio. The gearing ratio. Okay. Then we have what we call interest cover ratio. What is interest cover ratio? What is interest cover ratio? What is interest cover ratio? Now, interest cover ratio is talking about you had gone in for loan and you're expected to pay interest. How many times is your profit before interest and tax can be used to pay the loan, the interest on the loan? So interest cover ratio is looking at the profit before interest and tax. And we said profit before interest and tax is basically your gross profit. You know what gross profit is? Gross profit minus your operating expenses. Minus your operating expenses. That is what gross profit is. Net profit before interest and tax. And I've explained what operating expenses are, and I've also explained what gross profit is. So operating expenses, when you take them from the gross profit, it is the profit that is left to pay your tax and interest. How many times can it be used to offset your interest that you have taken? So look at the question. Now, these two items can be found in the statement of financial performance. That is the profit or loss account. So quickly go to the profit or loss account. Look at the types of profit. This is it. Net profit before interest and tax. This one. The figure is 24,3.4. So 24,3.4 divided by the interest you are supposed to pay. What is the interest according to the question? You see interest payable. And the interest payable is 24 divided by the 24. The number of times the profit you have made can be used to offset the interest you are supposed to pay. Now, that would explain gearing ratio. The next I want to look at is the profitability ratio. How profitable is the firm? How profitable is the firm? Now, to discuss profitability ratio and know how profitable a firm is, let us take it from the perspective of gross profit margin. And then let's look at the next one, net profit margin. Then we go to the very first two. These are the quite simplest one. My question is, once you hear gross profit margin, it means that gross profit in the question divided by sales multiplied by 100. So always it is in percentage. Your final answer must be in percent. So gross profit over sales, then you multiply by 100 and get it and put your answer in percentage. Now, I've explained what gross profit is and I've explained what sales is to you. So when you go to your financial statement, gross profit is already here as 495.4, and then your sales is already here in the profit or loss account as 2240. Just divide this number by this number and multiply your answer by 100. Okay, so when I do so, I have determined what they call the gross profit margin. Then the next one says that net profit margin. Net profit margin. It is the net profit before interest and tax. And you know where it is? It is in the financial performance. The net profit before interest and tax, the 2434 divided by the sales figure, 2240.8. That will give you what we call the net profit before interest and tax over sales. And that is for net profit margin. Net profit margin. Net profit margin. All right. Now, the very first two is the part that is confusing. Now, they ask you, what is the return? Okay, what is the return on shareholders fund? Who are the shareholders? These are the ordinary shareholders. They are asking you, what is the profit on the total amount of money these people, the ordinary shareholders, have contributed? Now, the ordinary shareholders' money can be found in the balance sheet. And then the return is talking about the profits after the net profit, after you have deducted the tax, after you have deducted the amount of money needed to be paid to preference shareholders. So the word is net profit after tax and preference dividend, if any. The if any means that it is not every question that will tell you that they have paid dividend to preference shareholders. So you see that in our statement, I told you that net profit available to ordinary shareholders. Net profit available to ordinary shareholders is after your profit after tax and you less the preference dividend. So normally, it is this profit that we use, the net profit available to ordinary shareholders. In the case whereby there are no preference shareholders dividend, you just pick that of the net profit after tax and use it. That is why they said, if any, it is not all question that will give you preference dividend. So it means that the net profit after tax becomes that net profit after tax and dividend. So this particular question, there was no preference dividend paid. So you see, though they had dividend proposed, we didn't have anything like net uh, preference dividend paid. So you just pick the net profit after tax and use that figure. But then assuming there's preference dividend paid, you need to deduct that preference dividend paid from the net profit after tax and now divide it by what belongs to the ordinary shareholders. So I've told you what belongs to the ordinary shareholders can be found in the balance sheet, and it is the addition of the ordinary shares. It is going to normally be under the equity. So I listed quite a number of things for you here under the equity. So you can see them. So all of these things belong to the ordinary shareholders: the stated capital, the net profit, the retained earning, and then the general reserve. So when I go to this, it is this one, and this one that I'll put together. Then it becomes, so the 4983, 8.3 is the monies that is for the ordinary shareholder. That is what the ordinary shareholder has contributed and has actually accumulated up to that point in time. So the question says that net profit after you have paid. So what is their return? Their return is the amount of money that belongs to them after you have paid all the expenses, after you have paid the taxes, after you have paid the preference dividend. What is the money for them divided by what they have contributed times 100%? Okay, having said that, the next question says that the next formula says that return on capital employed. What is return on capital employed? When we say capital, you can have shareholders contributing money, and then you can also have what we call debtors, people going for loan. Okay, so your capital can be the loan you have gone for plus what the shareholders have contributed. So the debt that you have, the long-term debt, let me use that word, the long-term debt you have, your long-term liabilities plus what the people have contributed. So we want to know the return on the part that belongs to the owners and then plus that of the long-term loans. So that one, we don't pick net profit after tax. We pick the net profit before interest and taxation divided by what belongs to the owners plus the loan we have gone for, that is over 1 year. That is the meaning of return on capital employed. I would end here and discuss the remaining two, that is the efficiency and then that of the interest, in our next video. If you have any question, try and then contact any of the contact details. That is the 05399484466 or 05076527761. You can do so by texting them. Do well to like our video and subscribe to our channel for more updates. Have a blessed full time. Bye bye. My name is Bernard. Bye.